In this presentation, we will record transactions related to financing sources for a capital project, putting these information recorded in journal entries, journalizing journal entries in the capital project fund, and government-wide activities. We'll typically start off with the government-wide activities because it will be on the accrual basis as opposed to the modified accrual in the capital projects fund, and therefore more likely to be familiar to us. We're going to have our trial balance. We're going to post to the trial balance. The trial balance will be in order: assets in green, liabilities in orange. Then the light blue is what would be the equity section in a for-profit organization: assets minus liabilities, net position in the government-wide activities. The dark blue then being what would be income statement accounts in a for-profit organization, or in this case, temporary accounts, accounts that would be closed out to what would be the equity section, in this case, net position. First item is that we're going to secure a note payable for the construction project. So we're going to finance the construction project, and therefore we're going to open up a capital project fund. We could think of the construction project as a bridge, a building, something that we are going to make. We need to finance it. We're going to get a note to do that first, a loan. It's going to look very similar to what we would expect from a loan in the government-wide type of activities on the accrual basis. That then, of course, being cash increasing. We're going to increase the cash. The other side is going to go to notes payable. So this is what we would expect when we get a loan for the government-wide activities, the organization, the entity as a whole. Cash then increasing with a debit. The other side going to notes payable, increasing the liability. Now we're going to consider, and when we think about this, then we want to think, okay, what's going to happen on the fund side of things? Now, here's the government-wide activity. What's going to happen on the fund side of things? Now, the cash is cash, so we would think that possibly cash is going to do something on a fund, in this case, the capital project fund. We would be suspicious of the note payable because the capital project fund, being on a modified accrual basis, doesn't typically record long-term liabilities. However, note, this isn't a long-term liability. This is going to be a short-term note. So possibly we're saying here that we have tax revenue coming in or some type of revenue that's going to come in. We have a short-term note in order to finance it for that time period. And therefore, we may put this on the books of the capital project fund given the fact that it's short-term and the note payable then is current. And under the modified accrual basis, we may still have it then in the capital project fund. Therefore, the capital project fund, as we're in now, will look much the same in this scenario. Again, the reason it does, be careful on the note payable. Is it short-term? Is it long-term? So we're going to record this transaction, same item on the capital project fund. The cash is going to be increasing. The other side going to notes payable increasing in the credit direction. Next item, back to the government-wide activity. We're going to say that the bond, we have a bond anticipation note. Bond anticipation note of $430,000. This, once again, is a form of note payable. So on the government-wide type of activity, it's going to look much the same. We're going to say, well, this is another form of financing. We're going to say cash is going to go up, the bond anticipation note then being the credit. Now, note the difference here. We're going to have a bond anticipation note, however. So possibly we're anticipating money or that's going to be coming from the issuance of a bond. So we might be thinking, hey, we need money right now to tide us over before we issue the bond, which is going to give us a lot of cash coming in, but we need some short-term cash right now. So in this case, we would think of it, basically it could be a short-term type of thing, bond anticipation note. However, we're anticipating to finance it again with long-term financing, a bond that we're going to issue. So when we consider the capital project fund that's going to be on the modified accrual, we're still thinking we're probably not going to include the bond payable, the note payable, the liability, because although it may be short-term in nature, it's really an anticipation of a long-term debt. So we're not going to pay it off in the short term. We're going to refinance it into a long-term bond. So we're going to be, when we think about how to record this government-wide activity, this transaction on the fund side of things, cash, again, probably going to be something that we will record. More skeptical now of the bond anticipation note as being something that we're going to record in the same fashion we would under an accrual basis on the government-wide activity. If we record this here, it's going to look familiar. We got the debit to cash, cash then increasing again. Then we have another type of note then increasing. So same kind of transaction here. Let's go to the capital project fund. And of course, this is the reason for all our financing because we're making something important, a capital project of some kind. And so in the capital project fund, cash once again is going up. This time, however, we're not going to credit the liability as we did last time on the note payable, because the note payable was current, because this is an anticipation note for further financing and not for revenue in the future. We're going to credit other financing sources, kind of like an income statement account, a flow type of activity. So we're going to say, all right, cash is going to increase. We got the cash. Cash is being debited, increase in the cash. The other side, the credit, then going to what would be similar to income statement type of accounts, increasing in the credit direction. So this account, other financing sources, proceeds from the bonds anticipation note, acts kind of like an income statement account, increasing similar to revenue, increasing what we would think of as basically net income, bottom line of if it were an income statement type of account activity, as we can see down here on the credit side, not representing a loss, but credits over the debits. Next one, we're back to the government-wide activity. We're going to issue another bond. Now we're going to issue the bond. The face amount of the bond is going to be the $3,210,000. We're going to issue at 98. What that means is 98% of the face amount. If we look at the transaction, the government-wide activities, it'll look much familiar for issuing bonds. That's going to be that bond's going to go on the books for the face amount. We're going to have to pay that back in the future. This is similar to a loan. We're financing our capital project. We're going to debit the cash that we're going to get. In this case, we're going to get less cash because we're only going to get 98% of the face amount. So 321,000 times 0.98. That's what we're going to get, $3,145,800. And then, of course, when we get something less than what the face amount is, we call that a discount. So we discounted, and we have the discount that we're going to record on the difference. If we record this, then we're saying cash is going to go up. We're increasing cash because we're financing our capital project. Cash is going to go up with the debit. The bond payable, here's the bond payable. It's going to go up in the credit direction. And then we're going to have a debit of the discount. So here's a debit of the discount of the bond. Now we want to think, okay, what's going to happen on the fund accounting side of things? We're going to put this in the capital project fund because that's why we took out the bond, in order to make a bridge or a building or a library or something big and important. And therefore, we're going to put this in the capital project fund. Then you want to take this journal entry apart and say, well, how is this going to look in the capital project fund? Well, we're still going to have the cash. Cash is going to be there, but the bond payable's not, because that's a long-term liability. So we're not going to have the bonds payable there, and we're not going to have the discount there. We're also typically going to put the cash on the books at either the lesser of, usually, the face amount of the bond or the cash amount. In this case, we issued it at a discount, therefore the cash amount is less than the face amount of the bond. So we're going to have to record the bond on the books at the cash amount. That's how much we're going to be able to have to use to finance. Then note that the financing of the debt may go to a debt service fund, something we'll talk about later. We're just concentrating here on the government-wide activities and the capital project fund. So within the capital projects fund, then we're going to have the cash is going to be increasing for the amount of cash we got. Again, it's got to be the discounted amount because that's less than the face amount. Then we're going to record the credit in other financing sources, which that looks kind of unusual. We're going to put it in other financing sources instead of into the bond payable, because this is the modified accrual basis and we're showing the flow activity that is here. And then another thing that's going to look a bit unusual, instead of debiting the discount as we did in the government-wide activities, because again, we don't have a discount in the capital projects fund, we're going to be debiting the other financing uses. And these two then are on what would be kind of like the timing accounts, similar to the income statement accounts in a for-profit accounting, and therefore they're going to net each other out. If we post this out, then we've got the cash increasing. So here's the cash. We're going to debit that. It's going to increase. We've got the other financing sources going up in the credit direction. And then we've got the other financing uses, and those two things are going to net themselves out on, in essence, basically similar to the income statement, or net out in similar way that we would think of as income and expenses netting up in like net income in a for-profit organization. Next, we're going to go back to the government-wide activity, and we're going to have another bond that we're going to issue. Now we're going to issue a bond, but this time, and as opposed to having a discount, we will have a premium. We're going to issue it at 101. Compare and contrast this financing for our capital project, where we have a premium, to the bond that we had a discount in the prior item. So we're going to put this on the books. We're going to get the bond payable is going to go on the books for the face amount. 101 means we're going to issue it at 101%. So we're going to have like 5810000 times 1.01. So that's how much cash we're going to get, 5,868,100. And then the difference is going to be in the premium. So now we have a premium as opposed to a discount. We got more cash than the face amount of the bond. If we were then to post this, cash is going to go up in the debit direction. There's cash increasing. Then we have the bond payable. So here's the bond payable, and it's going to go up. We're putting this to the same account. So you might have different bond payable accounts, but we've got 2 bonds in this payable account now. And then we have a premium. So we have the premium down here on the bond payable. So now whenever we do this, we want to think, okay, there's the government-wide activity on the accrual basis. What would happen on the modified accrual type, or what's going to happen to the fund accounting items? Well, we're going to put this in the capital project fund, because the capital project fund, that's why we issued the bond. The cash is going to go up again. However, this time we're going to increase the cash not for the amount we got, but for the amount of the bond, because that's what we're going to allocate to the capital project. The difference is we're going to say the premium, which we're going to use to finance the payment of the bond and the interest of the bond. So that will typically be something that we're going to deal with in the debt service fund as we go to the financing of the bond. We'll talk about the debt service fund later. Just for now, note the government-wide activity looks normal as we would issue a bond, it being on an accrual basis. Capital project fund, then we're typically going to be recording the lesser of face amount of the bond or the amount we received. If we have a premium, often the case, then we're going to record it at the face amount of the bond in the capital projects fund. Discount, then we're typically going to record the cash at, of course, the cash we got, which is lower than the face amount. So in this case, then we're going to have a debit in the capital projects fund. We are now in the capital projects fund. Debit of the face amount of the bond, and a credit to not bonds payable, modified accrual basis, not accrual basis, other financing sources, proceeds of bonds. If we record this out, we're going to say that cash then is going to increase. So cash increases, and the other side is going to go to other financing sources, kind of like an income statement account, increasing what would be similar to net income in a for-profit organization in the credit direction. Next, we're going to go back to the government-wide activity, and we're going to another example of financing sources for our capital project. We have the construction-related bonds sold. This time we have the face amount, and we have the rate, and we have 2 months of accrued interest. So in this case, we want to post out or show the 2 months of accrued interest. The journal entry is going to look like this. Once again, we're financing the project. Therefore, we're going to get cash. We're going to put the bonds payable on the books, this time at the $3,130,000. And what about the 2 months of accrued interest? We're going to say that the accrued interest of 2 months is going to be 3130000 times 0.044% interest. And I'm going to divide it by 12 to bring it down to a monthly amount. So that would be the interest per month times 2 months. So there's going to be the 20,867. So we have the accrued interest liability, 20,867. The 20,867 and the bond payable is going to be what the debit's going to be in terms of the cash amount. So if we record that out, then we will then have the cash. Cash is going to be increasing. So we have the debit to cash, increasing the cash. We've got the bonds payable then on the increase as well, this time in the credit direction. And then the difference being to a payable, accrued interest. Now we want to think about, all right, what are we going to do about this on the fund side of things? We did this, we got this money in order to finance the capital project. So we will be using the capital project fund. The cash will be increasing. That's going to be fairly straightforward, but we're going to be increasing the cash not for the amount of cash, because we're going to put it on the books at the bonds payable amount and finance the rest of it, posting it to the debt service fund. We'll take a look at the debt service fund in a future presentation. Therefore, the capital project fund will look like this. We're going to say that the cash is going to be increasing by the $3,130,000. We're going to increase the credit side will be the other financing sources, not, of course, to a payable account, a long-term payable, a bond payable, but to something similar to an income statement temporary type account, increasing something similar to what the net income would do. So if we then post this out, we're going to say that the cash is going up. So we have an increase to the cash. And then we have an increase to the other financing sources. So other financing sources also going up, this going up in the credit direction. Here is a summary of the journal entries that we have recorded in the government-wide activities. We've got the general journal on the left. We posted those to the worksheet. We have the beginning balance, the adjustments, and then the ending balance. The adjusting entries you can see will be a summary of the information on the left. For example, the cash account will include the cash account we have here, the cash account we have there, the cash account we have there, and the cash account we have there and there. So that will be the summary of the activity. If you want to look through this problem in the Excel file, we also worked through this problem in Excel, so you can put it together yourself there. We also have the capital projects fund, similar transaction. We have the general journal and the journal entries in the general journal. We then post them to our worksheet on the right-hand side, so you can see how that is put together as well.